And may the fourth be with you. Let's all just join in our Star Wars day. I grew up with that movie, so I'm a big fan. Uh, Wall Street Journal with going to have to eat their words from last Monday's story on OpenAI, and that created a 48-hour fear selling moment in Wall Street and AI stocks, which completely reversed by Wednesday and turned into a 3-day rally as the hyperscalers, Google, Amazon, Meta, and Microsoft all reported last week. We'll show you what the numbers actually tell us about what's happening in artificial intelligence. The real problem with the Wall Street Journal is the negative connotation they tried to apply to the OpenAI story that they ran last Monday, which caused 2 days of selling in tech stocks. It was an OpenAI problem. It was not an artificial intelligence in general problem, and I'll show you how that played out through earnings reports last week from a number of companies, not only that we own and trade in the AI2 portfolio, but also others that are related. Second thing, the AI2 portfolio hits multiple milestones in 1 week last week. First, the current portfolio hitting a 50% return on open capital. Second, one stock hitting a 200% gain, and then going on to hit a 300% gain in the same week. And then 3 stocks now with triple-digit returns in the portfolio. What a week. Let's hope we have another one. I'm John Hutchinson. This is Breakfast Club. Happy Monday to you. Let's get down to all the details that I have for you today. So as they started out last Monday, the big story was about OpenAI. The internal metrics suggesting the OpenAI is struggling, and in the article's context, and the real issue for OpenAI is competition. It is the fact that there are companies now like Anthropic, Manus, Perplexity, and others that are encroaching on a space that OpenAI through ChatGPT largely owned in the first 3 to 4 years of artificial intelligence being rolled out sort of through ChatGPT. And in the story, they noted that OpenAI was missing active user goals, and that the money that they are planning to spend for expansion, for growth, is not anywhere close to the revenue that they're generating. The underlying issue for the market was they took that as that this was rolling over the entire AI infrastructure complex, which just was not true. So they have an impending IPO, at least an IPO deal that they're trying to pull together. So there were serious questions, and there are serious questions about OpenAI. But all of that changed by Wednesday, and what drove that change was all of the earnings reportings that came out across the tech week of earnings last week, and we'll get more insight this week into other areas. And the key areas were semiconductors, memory, storage, and optical. And across a group of companies, essentially every single company beat earnings, every company beat revenue, some of them spectacularly, and every one of those companies increased forward or raised forward guidance. Again, the holy trinity of earnings, and that refuted the underlying argument that the Wall Street Journal was trying to present in their article, that the spending was out of control and wasn't being returned. There are other issues that actually exist, which I'll share with you here. But you can see what happened just in our AI2 portfolio. We started the day on Monday at just under a 49% return on open positions. And over the 2 days, Monday and Tuesday, that dropped by about a total of 16%. And then by Friday, we were back to a 50% gain. So in 1 week, we round tripped 32%, 16 down and 33%, 16 down and 17 back up. And the what happened, everything that happened between Tuesday night, Wednesday, and Thursday. And that is a slew of earnings that came out, starting with Corning and then expanding to the four core hyperscalers, and then even into memory and storage with Western Digital, Seagate Technology, and other companies, all telling an entirely different story. And that's what changed last week. That was one of the main drivers. There was also some economic data, which all overall continue to imply that the economy is holding up, even against the backdrop of higher oil prices, high gas prices. And we had the most anticlimactic Fed meeting ever. Nothing happened. And Jerome Powell saying that although he'll step down as chairman of the Fed if and when Kevin Warsh is confirmed, that he's not going to give up his seat. And that provided a backdrop of rate stability, meaning that the Federal Reserve is not likely to simply become a rubber stamp for whatever President Trump thinks interest rates or wherever he thinks they should be. So there is still a battle inside the Fed between raising interest rates, lowering interest rates, or keeping interest rates steady. That's a good thing. That is the equivalent of gridlock in Washington. And sometimes gridlock is best. Gridlock on the Fed right now is probably what's best. Unless or until we have clear economic signals that say rates must be cut or rates must be increased. We don't have that right now. So a stable Fed in that regard is the best path forward. Even if Wall Street has to do a little extra work to figure out where rates should be in the future, I'm okay with that. Stability, really the name of the game. And we had that by the end of the week last week. So, but one of the biggest steps I took last week, in part because I was mad and I overreacted precipitously, was I jumped back into a number of the positions that we hold in our AI2 portfolio on Tuesday, on the big down day. And I told AI2 members, if you're looking for a discount day for the stocks that we hold in our portfolio, that it was that day. And it turned out that Tuesday was that day. It was the discount day. If you wanted to buy Lumentum and get the best price you were going to get on Lumentum in the last 40 days, it was Tuesday. And it turned out to be Tuesday was the low. And my reasoning on that, even though I say it somewhat facetiously that I was mad, is this. I'm continuously seeing that Wall Street is rapidly overreacting to either news on CNBC, some Financial Times, Barron's, Wall Street Journal, et cetera, and then they go to lunch or they go to the bar and they say, oh, wait a minute, this story doesn't make any sense. And then they come back and they bid everything right back up. And when I looked across the spectrum of the stocks that we currently hold, the thesis, the underlying thesis of supply chain continues to bear itself out. So I added 2 positions in Lumentum, in Ciena, in Coherent, and in Advanced Micro Devices, 4 stocks that pulled back substantially on Tuesday. And then I didn't add a lot of shares, 2 here, 5 there. It was just enough to add a little extra exposure on top of what I currently hold. Because most of these are $300 to $800 stocks now. So I can't add that much given the capital or cash that I had in the portfolio. But it worked out. And by the end of the week, those little additional positions were in great shape. Max Linear continues to be one of the biggest stars in our portfolio. Is now up over around 300% since we originally bought it in February. That's on half of the shares, well, 67 of the 100 shares that I hold right now. I trimmed half shares before they reported earnings. They blew away their earnings report. The stock has gone up a tremendous amount in that time. So I added 33 more shares last Tuesday. And in that instance, I said that I was looking for price stability. And Tuesday was that day where it had a matching low. Went in 33 shares, stock has went up the rest of the week. and now sits around the $75 level. And then we added a new position in Marvell Technology, a stock which is due to report earnings later this month. They are an ancillary supply chain member in the optical market. And that's a company that I think is going to add substantial value to our portfolio in the next 30 to 60 days. So one of the lessons to share, remember the old adage, when everybody else is afraid, that's the time to buy, right? And when everybody else is going crazy, that's the time to sell. Well, Tuesday was that day of fear, and we bought, and that has worked out for us. That is why the portfolio continues to go up. In fact, even this morning, crazy futures market this morning. When I looked at the futures market at 4:30, the futures were up. NASDAQ futures were up about 0.5%. 2 hours later, NASDAQ futures were down 0.5%. Why? Because Iran claimed that they had fired missiles on a U.S. warship attempting to escort a tanker transiting the Strait of Hormuz. And then the news came out that refuted that story. It said, nope, that's not what actually happened. And then NASDAQ futures turned completely around, and now NASDAQ futures are flat. So nobody knows what's really happening in the Strait of Hormuz at all. But the real big story last week was the confirmation across all four hyperscalers. This is something I alluded to earlier in a previous Breakfast Club and throughout AI2. This is the source of truth for artificial intelligence as it relates to the broader ecosystem of stocks that we're following. Google, Microsoft, Meta, Amazon, all four confirming or raising the amount of money that they are spending to build out the data centers needed to support artificial intelligence. And in each of these four cases, actually in two of these cases, Google and Amazon, both companies showed substantial increases in the revenue that they're generating from their own artificial intelligence initiatives. Meta and Microsoft, not as much, or not so much, but still outperforming what was necessarily expected. Microsoft says that their AI run rate is growing at 100% per year, but the part of that is because it's linked to some of that is linked to systems, processes, programs that are already in place. But nevertheless, the story that this told was that there was no change in capital expenditures expected at the hyperscale level. And in some cases, they specifically noted that the increase in costs due to demand forced them to raise the amount of money that they plan to spend just this year. And an example of those costs come from the memory segment. Micron, SK Hynix, other suppliers of memory at top-end prices because supply is too low. Demand is far outstripping supply, not just this year, not just next year, but now into 2028. And this is what I'm calling this right now is a generational manufacturing shift in technology, one that is not priced into the stock market. It was not anticipated or expected in the way that it's playing out. And it is one that will play out much further in time than I think most people expect right now. Or my rationale, my reasoning for that, it would work like this. If we were looking at some of the other sectors, we have memory, especially high bandwidth memory right now. I've talked about this with the AI2 folks in our briefings, and that is, this is the HBM4, which is what Micron ships right now, is memory today, memory capacity, memory capability, excuse me. A year from now, they may be on HBM5. They may have super high bandwidth memory. I'm making that up. Right. In other words, the chips, whether it's in semiconductors or memory, et cetera, the pieces and parts that are shipping today, that are being manufactured today, are not the same pieces or parts that will be shipped and manufactured 2 years from now. They will change. They will have to change in order to keep up with the speed and scale demands of artificial intelligence. And as artificial intelligence shifts from what is right now generative AI to artificial general intelligence, and in the Star Trek world, artificial superintelligence, that is the long-term growth trajectory for artificial intelligence. I think ASI is probably years into the future, but artificial general intelligence is not. It may be 2 to 3 years into the future. Well, the current infrastructure doesn't even support that level of artificial intelligence. The difference is current artificial intelligence, you have to tell it what to do. Artificial general intelligence is it knows what to do, or it can do for itself. It can think for itself. Artificial superintelligence is the end of the world. I say that, I'm kidding, but I'm not going there. AGI is the next major iteration in artificial intelligence, but it is still 2 to 3 years in the future. But this entire layer of infrastructure, memory, optical, GPUs, CPUs, the power grid, servers, computers, compute capability, all of that's going to change. So this is not even with stock prices in some of these stocks that we're following being at what I would term insane price levels, there's no, where's the pullback? Meaning, what is the thing that causes them to fall 50% and make them cheap again? And I don't know what that is right now. I can't see what causes that, because the current cycle that's taking place isn't ending. Every single one of these sectors inside of artificial intelligence is backlogged this year, next year, and in some cases into 2028. And in many of the companies within these call them 5 quadrants of the supply chain realm, are increasing their own capital expenditure in order to increase supply capabilities so that they can meet future demand. So this is not NVIDIA just investing circular money, where NVIDIA invests in Meta and Meta spends money back with NVIDIA. These are companies investing in their own capabilities to increase capacity to meet the supply challenges that already exist. That's an entirely different story than the one that was being told last year about artificial intelligence. And where we go from here, the number one thing is, if you do nothing else, just find companies that are in these 5 sectors. I'm not guaranteeing you're going to find a winner, but you have better odds of finding stocks that are going to move rapidly in these five little quadrants or sectors. Right now, AI2 portfolio is in memory, it's in optical, it's in GPU. We have a little bit of exposure to servers. We don't actually have any. We don't really have exposure to power. Amprius is the closest, but it's more power supply, power capacity, but not on a general basis, more on a small basis. So we need better exposure on power. That's companies like Vertiv Industries, Vistra, GE Vernova, CEG, Constellation Energy, and other companies like them. That's really where the power end of things comes from. But ultimately, this is a generational build out, and it is not going to end in 1 year. In fact, data center build outs are behind schedule across the country, and in part because supply. They can't get what they need, no matter what price they pay. So the big change occurred last week, not just because of the hyperscalers, but also because of earnings from a multitude of companies like MaxLinear, one of our big winners, and Silicon Motion, another big winner in our AI2 portfolio. But it was led by also Corning. Corning announcing 2 new $6 billion hyperscale deals and announcing that their optical capacity is sold out for 2026. Seagate Technology in storage, raising their fourth quarter EPS from just under $4 to $5 a share. That's a 20% increase in one quarter. And noting that their storage allocations are basically sold out through the rest of this year. It's April and they're sold out. Imagine going to Best Buy and all of the televisions are sold out until next year. That's what's happening in the supply chain market. And it's not just televisions, it's toaster ovens, computers, headsets, headphones, DVDs, right? It would be the equivalent of going to Best Buy without Best Buy going out of business and they have no stock. That is what is happening in the artificial intelligence realm right now. One of our other companies, ASE Technology, also raising targets for their advanced packaging capabilities by essentially 300 million, from 3.2 to 3.5 billion dollars. Their AI chip visibility, meaning their packaging visibilities, now extending into 2027, which means that they can forecast what their revenue is going to be much further out based on orders the order backlog that they already have. That's what's taking place. That's why I will tell you today that the Wall Street Journal right now looks foolish for the article that they posted last Monday without doing better research and separating the OpenAI story from the rest of artificial intelligence. They didn't complete the job. That's when I get mad at the media when they don't do their job that way. Just like I get mad at analysts when they get lazy and don't raise targets correctly. Anyway, again, the three big wins right now, Max Linear at just under 300% as of the close on Friday. Micron, 139%, one of our longest holdings, and we're going to continue to hold it. That stock, I still see that stock being in the 800s by the end of this year, maybe sooner. It's at 550. It will not take us that long to make that next $300 if they continue to outperform on their earnings and their earnings expectations forward. And Silicon Motion, another 100% winner, stock gapped up 45% of post earnings last week. So another strong earnings print on the back of multiples. And the funniest story that I shared with AI2 people last week is that these two companies tried to merge a couple of years ago, and then they didn't. And now they are in court suing one another over that failed merger. I think they should just walk away from that because it seems like both companies are doing just fine not having merged. But we'll see how that plays out in time. At any rate, let's move on to one last couple of little pieces here. Major earnings again coming up this week too. So between last week and this week, we have an extensive number of companies in the artificial intelligence realm reporting earnings that are key, what I would call key stocks in this realm. Western Digital and Seagate last week. This week we get AMD reporting, and then in a couple of weeks we get a couple more weeks in the future we will get Broadcom and Micron later in June. But we really are getting more. Oh, we have NVIDIA in 2 weeks too. But what we're getting is more visibility into how extensive that backlog of orders is. And more importantly, how these companies right now are raising what their expectations are internally. So for AMD and Lumentum, Tuesday we get a wrap day. Lumentum before the market, AMD after the market close, and Coherent and Kulik and Safa, a packaging company, Coherent in optical. We get those earnings Wednesday morning. So tomorrow and Wednesday, busy days. And then Thursday, one of our small caps, Amprius, big story that I'll be covering during the AI2 Insider briefing is what's happening in Amprius. Big battle taking place around the $20 level. We'll explore why in tonight's AI2 Insiders briefing. But they report earnings on Thursday. And Amprius is a battery company, so you wouldn't necessarily think that they are attached to AI2, except that what they are able to do is supply think of it as really small batteries that don't generate a lot of heat and don't require a lot of electricity. So it's an ancillary market to the power issues that hyperscalers and data centers face. And they are a company that is growing rapidly. They are expected to return to profitability sooner than was anticipated, originally projected in 2027. They may get back to profitability this year. If they do, the stock is going to move rapidly. We've been in the stock since $11. It's trading around 21. So we're still sitting on a $10 gain from our original shares and another $6 gain on additional shares that we added back during the March lows. So through all of those shocks last week, the total return right now, 90% for the AI2 portfolio. It's April. Week over week, we gained an additional 15 points from the previous week. Our open unrealized profit and loss over $20,000 on $42,000 invested. We're killing it, and we're going to keep killing it. We've got a lot to do today during the AI2 Insiders Briefing, so I will I'll be prepping for that the rest of the day, but I'm really excited. We have some I have a couple of really neat things planned for everybody. So, especially a full look at the financials for the first 4 months of the year. Our performance is doing it well. Is doing well. Excuse me. The biggest thing, really, though, is between the March editions and then last Tuesday's editions, we've made strategic buys on select stocks. All of those have paid off and have helped to elevate the overall returns. And we've also taken money off the table. We took off a little over $2,700 in profits last month, in the month of April, closing multiple trades or partial closes. So we're not just sitting on open capital 100% all the time, nor will we. We'll continue to make those types of decisions as we go forward. So the thing to keep in mind, the big takeaway, whether you're following AI2 or not, is this. Just because the Wall Street Journal says it, do your own research anyway, and make sure you are able to determine whether or not Wall Street Journal or anyone else is telling the whole story, or are they just telling a story. In this case, they were just telling a story. They didn't tell the whole story. And the last point is, remember, optical memory, semiconductors, semiconductor equipment and materials, packaging, semiconductor packaging. All of these are sectors that are worth exploring for your own stock ideas. Buy them, trade them, options, all up to you. Yeah, it's been a good week, and hopefully we get off to another good start this week. We'll see how things go. Morning, Joe. Thanks for being here with us. Tom, good to have you. Anna, how do you value companies that lack financial projections on FinViz like Navitas or Planet Lab? So when I'm doing something like that, I'm usually looking at price to sales. For a company that is currently printing negative earnings, give me a sec to bring something up. Let's go over. So let's say we're looking at Planet Labs, excuse me, redemption of public warrants. Yep, that's nice. So what I'm looking at, so number one, the question is, look at the timeline to break even is a year out, right? They're just starting Q1 2026. That's number one. Number two, earnings surprises are all over the board, so you can't count on anything there. But one thing I would look at is revenue growing. Yes. Is revenue growing faster than expected? Generally, yes. But the other function here is their price to sales. Right now, it's too high. If I'm in FinViz, this needs to be a black or green number. If it's a red number, it tells you that it's above the median for a company its size, is I believe how they position their coloration of numbers. But you'd want to see a company that is much lower in its price to sales. You can also look at market cap versus enterprise value. If enterprise value is greater, let me give you a tool. If this number is greater than this number, That implies that the company has more cash for expansion and operations. If the reverse is true, market cap is higher than enterprise value, then they have less cash, which means you can look at price to free cash flow. That's an extreme negative. That means the company has limited cash flow, and that money is being eaten up by current operations. So those two metrics, price to sales and price to free cash flow, along with this comparison, those are the three steps that I use from a fundamental metrics perspective, and then analyzing, or I mean, to a degree, future casting on the financial side. What does the earnings look like? I mean, if this company at 2 cents by 2027, that's essentially break even. If they're turning profitable, and if your plan is to hold through profitability, then what you eventually need is 2028 plus 2 years, right? So you need the growth trajectory from 10 cents out to 2030. If you don't have it, and I don't know if I would probably have it, but I can't look it up just yet. But I will for you during AI2. Just give me a reminder. I'll look it up before then. So at any rate, those are ways and metrics that you can do that. I see foreign countries having the same data center backlog availability as we do here in the States. Good question, Steve. And the answer is yes, because most of your primary companies in the AI supply chain they're not shipping only to the US. I mean, think about China. China is building out in order to compete with the United States on artificial intelligence. Europe, a little bit less so. And Europe, I think, especially Europe, is more NIMBY centric, NIMBY, not in my backyard. We saw that in the 1970s, 1980s with the nuclear reactor build out, except in France, where most of France's power is generated by nuclear. But there were huge backlashes against where they would put nuclear facilities back then. I think you see much of the same happening on the AI data center, so it's a slower build, but the overall demand is global. It is dominated by the US and China. I don't know the true percentage, but I would not be surprised if it's 80 to 85% of all demand being consumed by the US and China combined. But yeah, you're still looking at foreign. And the other thing is, it may be less expensive to build data centers in foreign countries. And that's number one. Number two, the other thing that we need to remember is, people are trying to think about how to put data centers in space. I'm not going to go down that path. Maybe the data centers in space can create new crop circles in Iowa. Who knows? But this where to build them first is already a problem. If there's any delay in building them, not just in the US, but whether it's in Europe or in Asia, even the Middle East. One of the threats that Iran made during the height of the conflict back in, I believe it was late March, was that they were going to fire missiles at data centers that are owned by Google and Amazon, I believe, those two. Because Amazon has hosting facilities throughout the Middle East. So, they have exposure they had exposure on that level, but it shows you that Amazon is building in the Middle East even. Whether it's a great place to put a data center or not is not up to me, but it shows you that the build out is global, and not limited to just the US. So that's a great question. Appreciate that. But yes, I do think that the backlog is equivalent. To what level, though, that I'd have to do some research, and maybe next week I'll have an answer for you. Appreciate that. All right, that is Breakfast Club for the day. Let's hope everyone has a great week. I know we have fewer trading sessions this week, as Dave and I are actually getting together to work on a really exciting project, which we hope to announce next week. And then so I think Millionaires Trading Club is not meeting until actually Masters and Millionaires Club are not meeting until Thursday of this week. So check the calendar. We'll make sure to keep it up to date and let everybody know day by day. Other than that, hope you have a great week. Enjoy your Monday. And I will see you again next Monday morning at 9 a.m. for our next Breakfast Club.